high, lower high. What is this? Relative equal highs. So if that's relative equal highs, what's it doing here? It's just bumping that high and then doing what? Spending time. You do not want to see price stay in inefficiencies. You don't want to see that. You want to see them spend very little time in them and leave. You want to see when it's a bearish or premium array, you want to see the upper half not filled in, and you don't want to see it even trade to it. When there's a stop hunt, okay, if it goes above these highs like this and then spends time in there like that, that is the very nature of a fake bull flag. Go into the core content. I teach fake bull flags and bear flags and how to capitalize on them. And you're going to find that this is the usual catalyst for it. When the market is predisposed to go lower, and then you have relative equal highs like this, and there's a retracement. This looks like a reversal to someone that's not familiar. The unlearned, they will look at this and say, it's a breakout, it's a bull flag, okay? And they'll start drawing diagonal trend lines on stuff like this and wait for a breakout that never comes. Then you see the displacement here. And then now we have just completely entered several models I've already taught you. Optimal trade entry, 79, 62. The model 2022, so this is the 2022 model, and it's beautiful as well. Then you have silver bullet right there, institutional order flow entry drill, the lowest hanging fruit objective getting in, bang, hit it, okay? And it sells off. So you're not short on models, okay? All of them are profitable. All of them are correct. All of them are potentially used in conjunction. So that way you can enter on a higher one. And if another model speaks to you and says, here's another setup, and it's lower than your initial entry, what can you use that for? A pyramided entry. So when price is trading like it is here, returning back to Tuesday's daily low, that area just above and just below a previous day's low is rich in order flow. It's like a gold mine that can many times be mined. You can go in there and take something out, but you have to know what you're looking for. So some of the things that is outlined over here. And then grade your price swing. So if you think that we're topping out here because we're hitting Tuesday's low, how does it trade once it gets below that low? Is it lethargic, or does it get real quick and sudden and become real heavy? If it does, the easiest thing to do is jump right to the next pool of liquidity, because if you know this is the low of the day down here, this should not even be a speed bump, this low. So from this low here to that low, it should move to it, and then right before we get to this low, it's also what you see me do when I'm doing my recorded executions. When I am annotating and I'm expecting, I'll say I want to see speed and distance, or I expect large down close candles, large bearish candles incoming, something to that effect. Because I am identifying this low here, that low right here. And as we're moving from that low that's been taken out, I want to see how does it behave, how does it trade, and does it remain heavy? It does. And then now right here, we're close to that, and they're not going to want to allow them to pull their orders there. So that's when you anticipate speed. The magnitude of the move should start increasing, and you want to see it get to that low, to it, and through it, and really drive to that level there. Because all of this movement here is tricking traders to think that it's made its low here. It ain't going to go any lower for the rest of the day. That's what retail traders will think. And if they don't know how to take that position off because it's traded to liquidity here, they will hold on to the positions too long, and that winning trade either won't pan out because they're looking for something higher up for a target, or they just hold on to it too long and it does this and then rolls back over top of them. I want to see lows that I'm anticipating and expect to see them targeted as they're trading, and as the daily range is expanding. In this case, it's making a larger daily range with a potential lower close. I want to see, as we trade into the lows that were formed intraday, I want to see it accelerate as it gets close to them, knowing because the low here, anyone that was long, their stop loss is here. Anyone that bought down here, they've trailed their stop loss here once it started going higher. The ones that are more stubborn and say, no, I don't want to rush my stop loss up. I'm just going to keep it right here. They fall victim. These fall victim. But you determine it by watching how you behave below the first low. Once we have that shift in market structure here, that next one here tells you the narrative on how you're going to trade. Is it going to aggressively run for that low? You won't know that until we start to see how we behave there. It trades down below it, comes back up, leaves a small little gap. That's exactly what you want to see. That's your breakaway gap right there. Breakaway gaps form from consolidations or at the beginning of a first stage or second stage distribution or reaccumulation. So if we're looking at this as a market maker sell model, the curve is here, smart money reversal, low risk sell. This is an area of redistribution. When we break like that, it leaves that little gap. At the time, we pierced that one. That low is the first one after the shift in market structure. This trading below here, this gives you a very obvious level to look for lower prices. As soon as we start to see price drop, the run that takes out that low, if you see that with a gap right here, you want to see it stay open. Expect it to stay open. Can it come up and close it and still drop? Yes. But if it leaves it open, it's kind of like tipping its hand saying, I'm really going to go a lot lower, and it's going to be very fast. So don't be so in a rush to get out of the trade because I'm going to be moving a lot of distance and a lot of speed. So just hold on tight because we're going lower. And the market dives, consolidates. Look at all the candles, all lower highs. That's heaviness. Then we break again. All the next candles, are they making any higher highs? No, they're staying heavy. And right here, look where we are at that level in relationship to that low right here. We're very close to that. It's only, what, 25 handles or so? So it's going to traverse and travel very quickly over 25 handles, 25 points, if you will, if you look over here, but it's not technically always 25 handles. It's whatever is relative to where the low is if you're looking for it to drop down. When you start seeing it consolidate, but it gets real close to proximity. I don't have any rules, so I can't say like it's this many handles or this many points away from a low. Then that's exactly. It's kind of like a knack type thing because you can see that we're well beyond from where we are here, and right here we're closer to getting to that low than retracing all the way back up to here. So I guess if I was on the fly and gave you a rule that I guess could serve you pretty good as a general rule, if the high here to that low is the range we're looking at, as soon as we get to halfway point and below it, and what do I mean by that? It's like this, that low to that high. As soon as we get below midpoint, it should start to move very quickly, and it should give you all the indications that it wants to move lower and fast. And what does that look like? Every candle is just staying lower than the previous one. And then when it gets real close to that low here, look how it accelerates real fast. So this drop here accelerates into that low, and you don't want to just see it hit that and consolidate or retrace. You want to see it hit it and drive aggressively down here, because anyone that has their stop loss here, they're toasted there. But the ones down here, we don't even want to see them get the opportunity to go whew, and have a sympathetic sigh and relax like, okay, I'm glad I didn't have my stop up there, because as soon as it gets below here, it's going to run aggressively in minutes, just like that, to knock them out. And that's how you see that delivery there. So all through this point here, all in this consolidation, we're at 386 and a quarter. Okay, look at the chart on the right hand side. Look at this one over here. Okay, whatever I'm doing over here on this chart, annotating on the 1 minute chart, the price is being highlighted in the same price on that 15-second chart. So when we go to this area over here, you can see how price creates that little gap in here, trades up to here. This is all 15 seconds, and it drops, remains heavy, small little volume imbalance right there. Wick, halfway point. It can go above halfway point because you can allow for a little bit of movement above it. That's a mohawk. What did it really do? It just went in here to get that covered up. They laid down another candle over top that volume imbalance between that candle's close and that candle's open, and then breaks lower. Immediate rebalance, drops, small little volume imbalance, comes up, overlaps it, drops, volume imbalance, trades up, bearish order block. Two things are being done. Order block, volume imbalance, trades up here, and then dives again. Immediate rebalance, drops,